The United States has taken unprecedented steps by establishing its first strategic Bitcoin reserve under a 2025 executive order, signaling a major shift in retirement account asset allocation policies. This initiative makes it possible to hold cryptocurrency within retirement vehicles like 401ks, blending traditional financial instruments with digital asset classes. The move reflects a broader acceptance of crypto as a legitimate instrument for long-term savings frameworks. Policymakers are presenting this as a strategic pivot toward diversification of national financial reserves. Investors in both institutional and retail segments are closely monitoring the potential ripple effects on crypto market valuations. Ethereum's market capitalization has surged past $519 billion, overtaking MasterCard and Netflix and reinforcing its status as one of the most valuable assets globally. This continuation of upward momentum stems largely from increasing institutional inflows into spot ETFs, which have boosted Ethereum's market visibility and credibility. Analysts note that this milestone underscores the accelerating convergence between traditional equity markets and digital asset investment strategies. Ethereum's growing heft on the global market stage signals newfound investor confidence in digital infrastructure. This development has spurred renewed interest in decentralized finance tools and smart contract applications. Inflationary pressure is easing in key economies, leading to renewed speculation about potential rate cuts by central banks in coming months. Many investors are recalibrating their portfolios to favor fixed income securities and dividend-paying equities, anticipating lower borrowing costs ahead. Bond markets are responding with declining yields, particularly in developed nations where inflation reports have cooled. Analysts suggest that this could signal a broad shift toward more accommodative monetary policy globally. Markets are especially attentive to central bank communications for confirmation of policy easing trajectories. Global equity markets experienced modest gains as positive earnings surprises from technology firms offset concerns over slowing manufacturing activity. Traders report increased participation in growth and innovation sectors, especially consumer tech and semiconductors. Market watchers highlight the resilience of investor sentiment amid patchy macroeconomic data, indicating optimism in corporate leadership and cost efficiencies. This bifurcated momentum shows that investors remain selective, favoring companies with strong fundamentals. Continued gains in major indexes point to cautious but persistent bullishness across global markets. Institutional adoption of XRP is gathering pace, with major financial institutions and universities increasingly integrating XRP-focused curricula and research programs. Ripple's University Blockchain Research Initiative is spearheading these efforts, funding university programs that explore the viability of XRP as a global payment and settlement solution. Academic institutions are now viewing XRP not just as an asset class, but as a research topic with real-world application in digital payments and interoperability. This educational shift highlights growing recognition of the XRP ledger's utility in financial systems. Talent pipelines are adapting accordingly, breathing new relevance into blockchain education. Binance Corp, or BNB, hit a new milestone, surpassing $112 billion in market capitalization and overtaking traditional institutions like DBS Bank and Strategy in global asset ratings. The rise reflects investor confidence in BNB's ecosystem, including its utility in trading, staking, and decentralized finance applications. Despite a slight dip in daily trading volume, price gains and strong technical indicators point to continued bullish momentum for BNB. Its ascent into the top 200 global assets underscores the expanding credibility of crypto-linked financial instruments. Institutional interest appears to be a driving force behind its sustained growth. Recent weak employment figures have prompted Federal Reserve officials to reconsider the number of rate cuts appropriate for this year, with some policymakers signaling support for as many as 3 rate reductions. This evolving narrative has boosted risk assets, particularly in technology and consumer discretionary sectors, as markets price in more accommodative above its yearly low, marking one of the stronger rallies in recent memory. Additionally, whale accumulation and retail participation added fuel to emerging momentum. The combined effect is supporting broader crypto market sentiment. Several high-net-worth investors and institutional participants are increasingly turning to digital assets as hedges against geopolitical uncertainty and financial system instability. Traditional safe haven instruments like gold and bonds remain relevant, but crypto is gaining traction as a complementary asset class with unique upside potential. Analysts suggest that diversifying across both traditional and digital instruments may improve portfolio resilience in volatile markets. Asset managers are reportedly expanding their mandates to include regulated crypto exposure. The trend reflects a growing acknowledgement that digital assets can coexist with conventional investments. Emerging market currencies have strengthened against the US dollar amid signs of improved global trade activity and weakening dollar sentiment. Investors are rotating out of dollar-denominated holdings in favor of more diversified currency exposure, bolstered by promising export data from Asia and Latin America. The dynamic highlights shifting market confidence toward developing economies that are benefiting from offshoring trends and global supply chain reconfigurations. Central banks in these regions may tighten policy if inflows persist, adding further momentum to their currencies. Portfolio rebalancing is underway to reflect changing macroeconomic fundamentals. Energy prices have stabilized after recent fluctuations, providing renewed clarity for investment in fossil fuels and renewable technologies alike. Energy and natural gas prices have steadied, helping energy producers recalibrate budgets and operational plans. Meanwhile, capital continues to flow into green energy projects as global transition trends persist. Analysts predict that sustained price stability is vital to financing large-scale renewable infrastructure, particularly offshore wind and solar farms. This equilibrium in energy markets is restoring investor confidence and facilitating balanced investment decision-making. Investor focus has shifted toward corporate treasury optimization as companies seek to maximize returns on idle cash in low-interest rate environments. Cash management strategies now emphasize short-term investment vehicles, money market funds, and T-bills, offering yield while preserving liquidity. Multinational firms are also leveraging excess cash through tactical bond purchases and certificate of deposit ladders. Markets are responding positively to firms maintaining strong balance sheets and disciplined liquidity strategies. Analysts see this as a sign of increasing financial prudence following recent macroeconomic volatility. Central banks in Southeast Asia are signaling potential rate adjustments in response to moderating inflation and slowing credit growth. Policymakers are balancing stimulating economic activity with maintaining financial stability amid uncertain global conditions. Markets have responded with anticipation, leading to decreased yields on short-term government securities and slight equity market strength. Analysts expect further rate decisions to support domestic demand while safeguarding against overheating. Regional investors are adjusting portfolios to capture the benefits of softer monetary policy. Corporate bond markets in the United States are witnessing their largest inflows since 2020 as investors eye high-grade debt in search of predictable returns amid slowing economic growth. This surge reflects a shifting sentiment toward fixed income as a defensive complement to equities. The inflows have had a stabilizing effect on credit spreads and yields, improving conditions enabling faster decision-making during market stress events. Investors report that AI-enhanced strategies are helping them adapt more quickly to evolving macroeconomic indicators. The shift is also fostering greater adoption of algorithmic rebalancing and scenario stress testing in portfolio construction. Financial institutions are positioning AI as a critical competitive advantage. In the bond markets, inflation-protected securities are attracting renewed interest as inflation rates display signs of bottoming out. Investors seeking long-term income certainty are favoring TIPS and similar indexed bonds to safeguard purchasing power. Portfolio managers highlight that these instruments provide insurance against unexpected inflation spikes and enhance portfolio resilience. As macroeconomic conditions stabilize, demand for protection instruments remains elevated. Markets continue to monitor inflation data and central bank commentary for guidance. IPO activity in the healthcare and technology sectors remains strong, with several companies filing registration statements and engaging with institutional roadshows. Market demand appears robust for new offerings, particularly those combining digital services and resilient revenue